Hi everyone, in today's video we are going to learn about the cash flow statement. Okay, the cash flow statement does exactly what it sounds like. It reports a company's cash inflows and outflows over an accounting period. Okay, as the name suggests, the cash flow statement is the statement which provides company an information of outgoing and incoming cash flows. That is cash inflow and cash outflow. What payments that a company has made in a cash and what earnings that company has made in cash. All these records are maintained in statement of cash flow. Okay, cash flow statement versus income statement. What are the differences between income statement and cash flow statement? Okay, at first it may sounds like as if a cash flow statement fulfills the same purpose as an income statement. There are however some important differences between the two. The first one is there are often differences in timing between when an income or expense item is recorded and when the cash actually comes in or goes out the door. Okay, so here there is one important difference between cash flow statement and income statement. Okay, one is the timing difference. So what is timing difference? Timing difference means a company prepares income statement on an accrual basis. Okay, what is accrual method of accounting? Accrual method of accounting means company records all those incomes and expenses which are earned or recognized or incurred. Okay, whether it has been earned in or whether it has been received in cash or whether it has been paid in cash, it doesn't matter for income statement. Okay, the company records income and expenditure as and when the company earns the revenue and as and when the company incurs the expenses, unlike cash flow statement. In cash flow statement, company records those expenses or those incomes only when company pays pays out cash or only when company earns the cash. Okay, this is one big difference between cash flow statement and income statement. Okay, income statement follows accrual method of accounting and cash flow statement follows cash basis of accounting. So, for example, in September, XYZ Consulting performs marketing services for a customer who does not pay until the beginning of the October. Okay, the company has performed marketing services in the month of September, but the payment has not yet been received by the company until beginning of the October. In September, this sale would be recorded as an increase in both the sales and accounts receivable, and the sale would show upon a September income statement. The cash, however, isn't actually received until October, so the activity would not appear on September's cash flow statement. Okay, so company has provided services in the month of September, but until October beginning, the company has not received cash. So in income statement of the September, the sales or services which company has provided would be recorded, and the whatever the cost or whatever the service charges the company has the company has to receive will be recorded as an accounts receivable, because in the month of September the company has not yet received the cash but it has earned the cash, so earned in the form of accounts receivable. So company records sales and accounts receivable in the balance sheet. Okay, but company has not yet received the cash, so in September, in the statement of cash flow, there will not be any record of services provided by the company because it has received cash in month of October and not in the month of September. So this is one difference. The second major difference between the income statement and the cash flow statement is that cash flow statement includes several types of transactions that are not included in the income statement. Okay, cash flow statement includes several type of like transactions, like investing transactions, financial transactions, operational transactions, like which are capital in nature. The expenses or incomes which are capital in nature goes straightly to the balance sheet. Income statement records only those expenses or incomes which are revenue in nature, but cash flow statement records all those all like revenue and capital nature. Okay, example, XYZ Consulting takes out a loan with its bank. the loan will not appear on the income statement as the transaction is neither a revenue item nor an expense. It is simply an increase of asset, that is cash, and a liability, that is payable. However, because it's a cash inflow, the loan will appear on the cash flow statement. Okay, here it is an example. The company has taken a loan from the bank, but it is not recorded in the income statement because it is an liability for the company, because company has to pay loan. So one thing is liability has been created, and another thing is cash is coming to the company, so asset has been created. So liability and assets will go straight to the balance sheet. It is not recorded in income statement. But it is not the case with cash flow statement, as company has received the cash, so it has to be recorded in the statement of cash flow. This is one major difference between cash flow statement and income statement. Another example is XYZ Consulting pays its shareholders a $30,000 dividend. As discussed in previous lectures, dividends are not an expense. Therefore, the dividend will not appear on the income statement. It will, however, appear on the cash flow statement because it is an outflow of cash to the company. Company has paid cash to the shareholders in the form of dividend. Okay? So there are three categories of cash flow. When we prepare the statement of cash flow, there will be three portions, three categories or three parts, whatever you say. First one is cash flow from operating activities, second one is cash flow from investing activities, and third one is cash flow from financing activities. We will see one by one. Cash flow from operating activities. The concept of cash flow from operating activities is quite similar to that of operating income. The goal is to measure the cash flow that is the result of activities directly related to the normal business operations, that is, things that will likely be repeated year after year. Okay, cash flow from operating activities is as good as operating income calculated in the income statement. Okay, it is prepared. The goal of this cash flow from operating activity is to measure what cash the company is earning from its main operation. Main operation means the day-to-day activities that company perform, the main income source of the company. Okay, main business operations of the company. For example, company is into shoes manufacturing, then the manufacturing of shoes is the main business operation of the company. So the whatever the company has earned some profit or some income in the form of cash or cash flows from main business operating unit, in order to know that cash flow, we will prepare cash flow from operating activities. For examples, receipt from sale of goods or services. For example, in the business of shoe manufacturing, the sale of shoes, whatever the profits or whatever the cash we have earned from the sale of goods, that is one type of example. And another one is payments made to suppliers, payment made to raw material made for raw material purchases to the suppliers, etc. And payment made to employees in the form of salaries, that is direct wages. Here it is an employee who is into direct operating unit of the organization. Okay, not an indirect employee who are doing admin work or accounts work, who are handling some admin work. Okay, those are indirect salaries. Direct salary means the employees who are into the main operating business of the company is called as direct employee, and payment made to that employee is form part of cash flow from operating activities. Okay, this receipt is cash inflow, and payment made to suppliers and payment made to employees and tax payments is cash outflow. Okay, next coming to cash flow from investing activities. Cash flow from investing activities includes cash spent or received from investments in financial securities, that is stocks, bonds, etc., as well as cash spent on or received from capital assets, that is assets expected to last longer than 1 year, that is fixed assets. Okay, non-current assets. So cash flow from investing activities we calculate when we pay cash or we earn cash from some financial products or financial securities like stock, bonds, etc., money market securities, etc. So whatever the company has earned income from investing in other business or investing in some financial securities, that we record it in cash flow from investing activities. It also includes the whatever sale of the assets or purchase of assets we have made, and while selling the assets we have earned cash, or while purchasing the asset we have spent cash. All those cash inflows and cash outflows becomes a part of cash flow from investing activities. For example, purchase or sale of property, plant and equipment, purchase or sale of stocks or bonds, and interest or dividends received from investments, all these form part of cash flow from investing activities. Now coming to cash flow from financing activities, this one is important. Cash flow from financing activities includes cash inflows and cash outflows relating to transactions with the company's owners and creditors. Common items that would fall in this category includes dividend paid to shareholders, cash flow related to taking out or paying back a loan, and cash received from investors when new shares of stocks are issued. Okay, this main activity includes which is related to the company's owners or creditors. Whatever the dividend we have paid to the shareholders or owners, that form part of financing activities. Suppose we have taken a loan and the money has come in or cash has come into the company, that form part of cash flow from financing activities. And when we are repaying the loan, that also forms part of financing activities. When we are investing in the new stocks or we are issuing the new stocks, shares, preference shares, etc., equity shares, etc., that form part of financing activities. Okay, whatever which is related to owners and creditors, that forms part of cash flow from financing activities. Now if we can briefly look at the cash flow statement, so here it is a outlook or framework of cash flow statement. So first we will see cash flow from operating activities. So cash received from customers, cash paid to suppliers, it is outflow. Cash paid to the employees, it is outflow. Income tax paid, it is also outflow. Then all these, yeah, when we deduct outflows from inflows, we will get net cash flow from operating activities. And same with the case of investing activities, cash spent on purchase of equipment, and net cash flow from investing activities. And same with the financing activities, dividend paid, cash received from issuing new shares, and net cash flow from financing activities. Total will be this. Net increase in cash will be 1,90,000. Okay, so total will be total of operating activities, investing activities, and financing activities. That is net increase in cash. Okay, so this is enough for today. This is a brief introduction or brief knowledge about statement of cash flows. If you have any doubts, please post those questions in the comment section below. I will try to answer all your questions. And if you want me to make some videos on some other topics also, please suggest those topics to me, so I will definitely make videos on them and will post here. And if you like this today's lecture, then please keep supporting me. Please like my video, please share my videos, and if you are new to my channel, please subscribe to my channel and keep loving me and keep supporting me. Thank you so much, and stay tuned for new video. Until then, bye bye. Thank you so much.